Hello and welcome to the market update for Tuesday, January the 4th. Apologize a little bit ahead of time here. I've got a little bit of a cold. I usually get one this time of year, almost every year, but luckily it hit me after the holidays, so that's always a good thing or a plus. But if I have to take some pauses here from time to time to get a drink of water or something, just bear with me. All right. Well, yesterday it looked like we started off the new year pretty well. The indexes were breaking out. Today we're getting a little bit of a bearish reversal. Just in the near term, I think what could happen is maybe we could pull back and retest the breakout area. I'll show you that when we look at the charts here in just a second. Real quickly, the direction alerts. One thing to kind of point out here, you can kind of see it on this chart right here. You got your blue line, which is sentiment, your green line, which is breadth, and your red line, which is momentum. And this is what we've been talking about a little bit over the last few updates. We actually started to see it pick up as we got towards the end of the year there, but momentum has been lagging. Not momentum, breadth has been lagging. So there haven't been as many stocks participating in some of these moves. And again, what do I mean by that? If you have good market breadth, when the market is up, when the S&P is up for the day, there's a good chance that the 75 to 80% of the individual stocks are also up. And the reason why that's important when you have good market breadth, it's easier to make money because you don't have to be as precise on the stock that you're picking. You can almost pick any stock; it'll go up if the market's going up. The difference is how much, and obviously that doesn't mean we don't want to look for the best quality companies or the companies that are performing the best within those trends. But just from a probability standpoint, it gives us a better shot of making money. So whenever you see market breadth being really low, you don't want to be doing a lot of heavy trading during those periods of time. We'd like to see that kind of pick up a little bit here too, and kind of catch up with the other indicators here. You can see momentum is we were kind of pushing into the extreme area. We've kind of backed off of that a little bit. We're back into the buy area. Now this is actually bullish from the standpoint of when you combine this with the look of the chart. The chart looks like it's still trending upwards. So what this tells me, when you backed off of extreme into buy, and you look at the chart and you see a little bit of a pullback, especially if it's like a little bit of an ABC pullback, that's just an indication that the trend is consolidated a little bit. It's getting ready to take off, and we should see the market continue to move higher and see this indicator push back into that extreme range. Now, when you start to become concerned is when you start to get to the far right side of this extreme range, and you've been running up for a while. You've been moving up for quite a while, because that can be an indication that you're getting ready to pull back. And since we haven't been in the far right side of the extreme range right here, what I'll be looking for, if we do push into that, and I think we could push into that this month. I think we're going to get a bigger correction, either later this month or into February. We're due to have one. We haven't had one for a while. That doesn't mean that it has to happen just because you haven't had one for a while. But you just start to get a feel that we're due to have one. Now, it doesn't mean you start getting out of everything or shorting things just because you have a feeling we're due to have a pullback, but you start to look for extreme signals. I would start to look for this to get into that extreme reversal risk range. So let me kind of see if I can simplify this a little bit of what I'm talking about. Within your trends, you'll get your smaller pullbacks, okay, and that's healthy. That's part of the uptrend. But when you start to, when I see it get into the extreme reversal risk range, then back out into the buy range, or even when it's in the buy range and it backs off into the hold range on these little pullbacks, as long as we're still getting higher highs, higher lows, it doesn't worry me too much. I still will look to buy into that trend. But when you start to get to, when you've been in a trend for a little while, so you can see that you've been in an uptrend for a little while, and you start to get to the far right side of this extreme reversal risk, usually that signals a much bigger correction. Whenever the crowd gets too far to one side, in this case, it's getting too optimistic, too bullish, it usually signals that you're at a market top, and a bigger correction could take place. So what I'd be worried about in that scenario here is that we'd get a pullback, but it'd be a larger pullback. You get one of these larger pullbacks. And that's what I'm trying to avoid. I don't want to be caught up in that. Now, obviously, we're not going to be able to perfectly time a market sell-off, but when we start to push into these extreme ranges, I'm going to want to start backing out, getting into more of a cash position, because what I want to do is avoid this drop as best I can, and then start buying back in on that dip and ride the next wave back up. Now, I know that seems overly simplistic. It's like somehow I know exactly what's going to happen next. I don't, but that's the general. That's the way the market behaves. That's kind of the rhythm of the market as it moves in these kind of cycles. And I've done some trainings. If you haven't gone through those yet on the YouTube channel on Elliott wave analysis, it gets into this concept in a lot more detail. I'm not an Elliott wave fanatic, where I believe that everything in the market can be explained, or that I think that just understanding Elliott wave analysis can allow you to predict the future. You can't still, but it does give you a better feel of how these cycles work. And when you can recognize these cycles, then, for instance, markets tend to move in three main waves. You have the initial move, correction, the middle move, a correction, and then you get the final move. And these corrections are the impulsive moves. That would be wave one. This would be wave two, wave three, wave four, wave five. So markets tend to move in these 5-wave type cycles. Well, when I can recognize that, and again, they don't move perfectly like this, but when I recognize that concept, then I can kind of take a look at the chart and does it look like I'm in the middle stage of the trend where there could be a lot further for it to go? Does it look like we're in the later stages of the trend where I could be getting about to have a bigger correction? You can start to get a feel for where you are within the trend cycle. And what I'm talking about here is that we're probably pushing into this wave 5, this later stage. And part of that, what would start to happen in a wave 5 is that you start to feel complete optimism. Now, we don't have that yet in the market. Okay, there's still some fear right now, especially with some of the tech stocks selling off today and things like that. And what is inflation gonna do? But at some stage, if the market starts to really surge forward and just keeps going up day after day after day, what will happen is that optimism will get extreme, and people say, "Boy, this market is incredible. It's shaken off all this bad news or possible bad news. There's nothing that can take this market down." And when you get to that phase, that's when you the saying I like to use is, when it feels safe to get in, it usually isn't. When you feel like, man, I'm going to put all my money in right now. There's no way I'm going to lose it. And that's when you don't want to put your money in, because that's when you're about to get smacked. So, but those are things that I'll be looking for and I'll be talking about if I see it. Now, I've been talking about this possibility since summer. I mean, we were starting to push into these extreme ranges, close to them, and the market had a feel of getting a little bit toppy back in the summer. But obviously, we didn't get a large correction. We had some decent sized corrections, but we haven't had a large correction for a little while. So again, just because I'm anticipating that maybe we could push towards that, maybe sometime this month, and that maybe we could get a correction in February, doesn't mean that will happen. That could get pushed out again. I base everything off of what I see on the charts and what I see in these indicators, and I'm willing to change if the indicators tell me to change. And what happened last summer was we backed off a little bit, we consolidated, we didn't get to that extreme range, and that allowed for that trend to continue to push even higher. We just recently broke to new all-time highs again. All right, so breadth again, we're keeping an eye on this, seeing if it can kind of catch up a little bit here, see a little bit more increased market breadth, and sentiment again has really pushed into the extreme range. So again, that bullishness right now is already elevated, and what would happen is you'd probably see the sentiment indicator get to the far right first, and then you'd look to see if the momentum in breadth kind of caught up and got into that area there. From the buy-sell ratios standpoint here, we're not in any sort of extreme range. You are seeing buys outpace the sells. Again, if we get later in the month and those indicators get over to that extreme reversal risk area, and you've got the buys up here, the sells down here, where it's just the opposite of what it was back here, where the sells were outpacing the buys. But if we saw that kind of extreme range, the width there of that range, that would be a warning sign. Another warning sign that I don't use very often, but I do go through it from time to time, is before we get to that, the sentiment indicator is still pretty high right here, but it's backed off a little bit with the recent consolidation there. But you can go into the index tab up here, and this is another indication that the market is getting stretched. Is you can simply look at we are starting to get a little bit stretched here, aren't we? You start looking at the buy-sell ratios of the different indexes. See, I haven't looked at this for a little while. I haven't looked at it through the whole holidays actually, but you see the S&P 500 index right here. You got 254 buys, only 16 sells. When these ratios get to double digits, and they are at double digits, that's a little bit of that is a warning sign that things are getting a little bit stretched. Now, some of these need to catch up a little bit. S&P is obviously at double digits. You got the Russell 2000 is lagging. I think that you'd want to see the Russell would probably need to get up towards that double digit area there. But boy, looking at this, we're not too far away from this flashing a real warning sign. I'll have to start keeping an eye on that, because like I said, I haven't bothered to look at it for a while, just because I can tell. Usually, when even going back to the buy-sell ratio, this buy-sell ratio chart right here, we're not in any extreme range right there. So I'm assuming that we're not getting stretched on the index ratios there either. But yeah, and what's probably keeping this thing from being real wide right here is that Russell 2000 index. So I'll start keeping an eye on that, because that's definitely, again, you're not going to base any of these decisions on one indicator. Okay, just because you're in double digits in the buy-sell ratios doesn't mean that the market's going to collapse. But when you start to see them line up, when you start to see these in the extreme reversal risk range. These indicators in the extreme reversal risk. You're seeing market sentiment over that red line. You're seeing those index buy-sell ratios at double digits, and you see a stock chart that's been going. It's been stretched. It's been going up for a little while, and it's looking like it's stretched. All those things can start to signal or start to give you a warning that a bigger correction could be underway. All right, let's take a look at the charts. So you can see today. So first of all, you can see that we've broken out. We broke out to new all-time high. We did that last week, or was it the week before that? I think it was a week before that when we broke out, and then we consolidated a little bit. Today we opened higher, but we're looked to close lower. We have a little bit of a bearish engulfing candle formation there. So wouldn't surprise me if the market pulls back a little bit tomorrow, at least from what I'm seeing on this. Although I mentioned this a little bit last week, and I'll remind you again this week, that just the end of December and the beginning of January creates kind of a unique situation where there are some decisions that are being made by these big institutional traders that may not be based on longer term outlooks. Again, a lot of shuffling. They want to get certain stocks into their portfolio. They want to have certain stocks at the end of the year when they send out their annual reports to everybody to show that they're holding Tesla and Apple and Microsoft. But then they need that growth, and so they'll look for stocks that have the chance to make the bigger percentage moves during the year. They kind of shuffle into those in the early part of the year, and so you can get these weird moves that don't make a lot of sense because they're not necessarily based off of the long-term expectations of certain things, certain stocks. What's throwing a little bit of a curve into that is that we've got the bond yields have really shot up since yesterday, since the beginning of the trading of the new year, and so that makes these higher risk small cap stocks a little bit they're riskier. They're now, these big fund managers that would normally pile into those stocks have been getting out of those stocks, and so the ironic thing is that they were actually getting into them near the end of the year, and then they're getting out of them here at the first part of the year. Kind of opposite of what I would have expected them to be doing. So again, my job is not to try to be smarter than them, but to try to recognize what they're doing and try to follow along. The problem is I haven't been able to really kind of see what they're doing yet. But that'll start to establish itself over the next few days. Those patterns will start to emerge. One thing we can see early on is that a lot of the oil stocks are really taking off and performing pretty well. That's one sector that's been doing very well for the last month. So we'll see how this but overall, even though this is a little bit of a bearish candle, this is a consolidation right here. This could just be wave A, wave B. You could get a little bit of a move down for wave C, maybe retest that breakout area, maybe dip a little bit below it. But I would assume that we're going to continue to trend higher on the S&P. The Dow, again, it gapped up and it tried to rally, but it's come off the highs today. That's a shooting star candlestick formation. It's a bearish candlestick formation. Especially in the context here, we've had this big run up. What this is telling me is that the buyers are exhausted a little bit. The buyers are not able to hold this high. Now, again, this is a very short-term price action indicator here. It might just be this pulls back to that breakout area right here over the next day or two, and then maybe it finds enough buyers there that can move it forward. But again, if you just kind of use common sense, it just broke out today to a new all-time high, and yet it can't hold the highs of the day there. I mean, that's just showing you that the buying momentum isn't there. Now, again, we're still an hour and a half away from the market close. Could that candle look different? Could the buyers show up at the end of the day and close us near the highs of the day, and that candle would look different? Yes. But as of right now, that's not looking good. But that also matches up with what we saw in the S&P chart. Near term, it's looking a little bit weak and looks like we can maybe pull back a little bit. NASDAQ 100, you can see it's been hit the hardest today. And again, a lot of it has to do with those bond yields that have been going up. A lot of the tech stocks, there's a lot of tech stocks that aren't making money. And if you're not a company that's making a lot of money, then it's riskier when those bond yields are rising. It just, and inflation is coming. It'll affect future earnings or future potential earnings if they're not making any money. So, seeing a little bit of caution there. Now, because this is the NASDAQ 100, there's also a lot of the big cap techs stocks that are getting hit a little bit. But remember, those had a pretty good run late into the year. We saw this big run up right here. This is a little bit of a stronger run up than some of the other indexes. So again, this kind of looks today looks kind of like a wave C, wave A, wave B, wave C. And what we might see happening is we might see a little bit of a rotation. What you could see is maybe some of the Dow stocks, some of the S&P stocks pull back a little bit based on those candles, and you might see big cap tech have a little bit of a rally over the next few days. It might rally back up. Now, it hasn't broken out to new all-time high yet after this big consolidation through here. It's the next index to do it, and but I would assume that eventually it is going to, based on the chart here, it should eventually break out to a new all-time high with the other indexes. Russell 2000, it's also a little bit weak today, a little bit of a bearish reversal candle. I just don't know that it's going to get back to new all-time highs. I could see it push. I could see the other indexes push higher. This is pushing higher, and it gets close. But definitely, if it does go to a new all-time high, and we start hitting those extreme reversal risk areas, we'll look out, because that would really tell you that that things are stretched. But it's lagging a little bit too, and I think this gets back to that market breadth that I talked about I think I talked about in the last couple updates, that a lot of the drive of the recent move has been concentrated towards some of the larger companies. We haven't seen the smaller companies outperform. And that's usually what you'll see in a healthy uptrend, is that there will be a lot of participation. The bond market, you see bonds have been down. That means yields have been going higher. That's what I was talking about earlier. Now, again, we talked about this in previous updates. We had impulsive up right here. We had impulsive down. And then we had this kind of corrective phase right into here. Even had a little bit of a triangle formation that was forming. We did actually break below there on this little move right down here, tried to rally back up again. So basically what you can see here is we've been stair-stepping down. And you just take this move from here. You had impulsive, there's corrective, there's impulsive, there's a step right here, corrective, lower highs, lower lows. And you had this big drop yesterday. So this is definitely impulsive down. Now, it could be that this is a larger ABC correction of this move up, although this would need to look a lot more impulsive up, and it doesn't. But that's a pretty big move in the bond market over the last two trading sessions. So, excuse me, I would anticipate that we'd get some sort of consolidation, maybe something like this, where we're kind of back and forth. You can see up here that we're at the far left side of the extreme reversal risk. So that would tell me that it's probably a little bit overdone. But you can see it. You can see it here. Here we had a drop that was, you had a big drop right here. It looked like you had a little bit of a bullish reversal candle, and then it dropped again a little bit further before consolidating, and then it dropped even further. So I can anticipate, same thing could possibly happen here. Maybe you have one more gap down. That would kind of be the extreme. But then we'll probably do to have some sort of consolidation, and then possibly we can continue to trend lower. This is also why the financial stocks should really take off. The bank stocks, with those higher yields, allows them to make a little bit more money. And so we've seen a lot of the financial stocks take off with that move down. So bottom line, the trend in the TLT is trending lower. But we're extreme levels, so we expect a little bit of a bounce or a little bit of a sideways move off of that. We'll see if that ends up playing out over the next week. Gold has been, again, just kind of a mess to try to figure out. I keep going back to that long-term chart where we've just kind of been moving sideways for several months. Until we kind of break out, although we did break out of that sideways range back in the fall. Didn't hold right back into this range again. I'd still be looking to see if it breaks out above here, that'd be bullish. If it breaks down below here, that'd be bearish. But the bottom line is gold's in a sideways trend. Got to recognize that. That's how it's behaving right now. I wouldn't be, and again, we want to avoid sideways trends. So because you want the highest probability of making money. You want to see charts that are moving up. If you're saying to yourself, boy, if gold goes back up to here, I'll make so much money. It goes back up to this high. If I get in right here, I'll make so much money if it goes up to there. Well, yeah, you could play that game with every stock. I could take a stock that's gone from $100 all the way down to $2, and I could say, boy, if it goes all the way back to 100, I'll make so much money. But yeah, what is your probability it's going to go back up to $100? Very low. Stocks don't go almost bankrupt and then go right back to $100 stock again. It might take years for it to get back up there. It could take another year for gold to get back up to these levels. In the meantime, why not find a stock that looks like a rocket ship and go trade that? You want to make sure you're trading something that's moving. And I'd rather get stopped out. I'd rather be wrong on a stock that's trending up and then happen to get in right when it sells off and I get stopped out. I'd rather be wrong and get stopped out than get stuck in a sideways range for months. It's like the slow. That would be the quick death, getting stopped out. This would be the slow, torturous death. Waiting for it to take off. But yeah, gold is in a sideways trend, and I'd probably avoid trading it right now. Oil, though, on the other hand, has been trading up. Had a nice pullback right in here, and then since then, we're getting higher highs, higher lows. Coming off a little bit of a consolidation right into here. Looks like it's starting to break out again. Had a nice bullish candle yesterday, and then a little bit of fall through today. Now it's off the highs of the day a little bit today, but so's just about everything. But ultimately, it should work its way back up to this previous high and break out. So oil is definitely a sector that that you'd want to have some exposure to. The dollar, we talked about this being looks like a corrective pattern right into here. Looks like an ABC pattern. So you had impulsive. Here's corrective. Impulsive. This looks corrective. I would assume that the dollar is going to continue to trend higher. That hasn't changed. Now we've talked about that for a couple of weeks here. It's been still moving sideways. Remember the phrase I use all the time, which is whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moves sideways. That's the direction it's more likely to move in after it's done moving sideways. Now the key word there is after it's done moving sideways. Who's to say the dollar can keep moving in the sideways range for a few more weeks or so? But ultimately, when it's done moving sideways, it should break out and move higher. And that's the way it's acting right now. So that's what I would assume is going to take place. The VIX been dropping quite a bit. We did have a little bit of a bullish reversal candle today, so that kind of lines up with those bearish candles we were seeing on the S&P chart and the Dow chart. Did get a little bit of a bounce there, but overall, nothing in the volatility that's worrying me or showing that there's concern in the market. And again, that can change very quickly, but we're at very low levels in the VIX right now. Now, if we get to really low levels in the VIX, and again, combine that with extreme overbought conditions, that's when you have to really start worrying about that bigger pullback. The chip sector, SMH, again, a little bit of a bearish engulfing candle today, but this is probably just wave A, wave B, wave C, and you get a little bit of a pullback down into here. Here's a larger move up, a larger pullback. I think this is just correcting this move up right here. That was a pretty sharp move up. We saw that right at the end of the year. And this is just kind of correcting that move. Once that's done, it should resume the uptrend. And notice how that looks very similar to what the NASDAQ 100 chart is. That's why we compare the two, because the chip stocks they're like the old transportation stocks with the Dow Industrials. How the chip sector is doing is a great indication of how technology stocks in general will do, because all of them use these chips. And when there's strong demand for the chips, there should be strong demand for these tech companies as well. Dow Transportation Index, compare that with the Dow Industrials. This is very close to, we have the Dow Industrials already breaking out to a new all-time high. Transports are very close to doing the same. We are at the highs of the day, though, today. But these have been performing well. Again, this is giving us an idea of how the economy is doing. Railroad stocks, air freight, airlines, trucking companies, shipping companies, as they're trending up, it's telling you that the economy is doing well, and that's why we look at this chart. Bitcoin's been beaten up a little bit. I thought that Bitcoin was going to rally a little bit more off of this low, but it's clearly in a downtrend right now, and it looks like it's getting ready to go to another lower low right here. So I'd want to see a change of that behavior. If it goes to a lower low and then rallies and goes to a higher high, and then has a higher low, that'd be a stronger indication that's kind of turning the corner. And that's what I was looking for right in here. You had gone, you had these smaller lower highs, lower lows right through here. It broke out above that. Looked like you were getting a higher high right here. Pulled back a little bit right here. I thought, what, that holds and it goes back up again. Now you've got higher high, higher low. Could be indicating a trend reversal, but it just kept dropping. And now it's all the way down to here. It should end up breaking lower off of that. A couple stocks to look at. And I did end up getting stopped out of HBP yesterday. So I've got some cash I can put in. I like to put it into an oil stock. And if we look under the oil stock, we've got some of these in our watch list. And what I looked at here was I wanted to see if there were some of the bigger names, the better run companies that have a high enough strength rank. And one of them that jumped out was Continental Resources here, CLR, 95 strength rank, but it's a little bit more of an established company. Real quickly here, I want to, I got a good question last week, and I thought I'd address it here because I think it's important, particularly for newer traders. There's a tendency, especially if you have a smaller trading account, there's a tendency to focus on price. Looking at this list right here, you say, well, Jerry, why would I go with CLR when I can get PVL for $2.14? CLR is $48.23. Boy, if PVL goes from $2.14 up to $48, I'm going to make a killing. Why not buy that stock? Well, and part of what fuels this is you always hear about the stock that your neighbor or your friend or your relative or whoever bought it at $2 or something, and it went to $50, and they like to brag about it and how smart they are. And the problem is, though, for every stock that does that, there's probably 100 others that don't, that stay in that $2 range for decades. Okay. So my philosophy has always been, you got to understand, this stock is a $2 stock for a reason. I'm not trying to badmouth the stock. Okay, I really don't know anything about the company, but typically when a stock is down that low, it's down there for a reason. Maybe it's just starting out, but maybe it's just being run by people that aren't very good at running a company. And so what I would suggest you do is do not base your decision off of the price of the stock. Base your decision off of, is the stock moving? Because I don't mind a $2 stock if it looks like it's been moving. If it was down here at 50 cents just a couple months ago, and now it's at $2.14, and I can see on that chart that this thing is trending, it's moving, then I don't have a problem with that. But if this stock has been moving like this for a year, I don't care if it's a $2 stock. I don't want to own it. You'd be better off buying a $1,000 stock and buying one share of a $1,000 stock and have it, but it's moving. You'd be better off doing that. So as early as you can, get price out of your decision. You want movement. You want high strength rank. You want performance. Okay. And now if it so happens that you can get let's take a look at PVL. You can get this thing is, if we look at actually that's not too bad. It was down here. It was a penny stock down here. So that's trending in a decent amount. That wouldn't be terrible. But make sure it has this high strength, and can make sure also that it's not a OTC over the counter. It's trading on an exchange, which this is. But I just don't base your decision off of price alone, because if this could get into get to a level where it just starts moving sideways for a long time, or it gets stuck in a range. Maybe it only goes to $3 or $4 and it just gets stuck in that range. Meanwhile, you get a company that is better run, and just the price of the stock is higher. Plus, there's liquidity concerns. Look at the volume on this, very low volume, which means when you go to sell, you're not going to have as many buyers looking to buy from you. Those are factors to keep in mind. The bottom line is just don't base your decision off of how cheap a stock is, because remember, it's cheap for a reason. And typically, I don't like. There are exceptions to this. Usually, the exception is high strength rank, good trend. But I don't usually like to be in stocks that are under $10 if I can avoid it. Now, I have had stocks. I have stocks in the watch list that are under $10. But again, just make sure you're putting a greater emphasis on those other things: strength rank and liquidity and movement. All right. Anyway, so I'm going to. I do like CLR though. Continental Resources, 95 strength rank. And I think it went to a buy signal today. But what I like too is that it's kind of breaking out above this little range here. Went to a lower low right there, even high right here. You've got the higher low, and then today it's breaking out to a higher high. Again, that may not hold, but it has those. It's real, kind of that real subtle look that it's turning the corner and start to trend up. Now, we've had a few of these that they look like it's turning the corner, and they don't. They come right back down, but that's why we manage the trade and use stops. I'm going to put a stop down below here, and if it can break out above here in the next week or so, we can move that stop up immediately right to this level right here. So let me go through the stocks, and then we'll manage the portfolio here. So let's go and look at another oil stock. I don't know if I have this one in the watch list or not, but CPE right here, 97 strength rank, Callon Petroleum Company. Going to a buy signal today. The same thing. It's although this hasn't broken out yet, but it has this kind of an inverse head and shoulders pattern right here. There's your neckline. If it breaks out above there, you can take the distance from the base of the head to the neckline, project that upward. That lines up almost perfectly with the previous high right there. So there'd be a pretty high probability this thing could get up to that $65 area. I don't have enough cash to do both, but those are two that look pretty good. Under construction, I like this HOV, 97 strength rank. Now, this one I would probably, because by the time it goes back to a buy signal, you'll probably be right back up here. I'd probably wait for the breakout. But this is one that I've traded a number of times over the last few years, and it's had some. I think we got into a trade back in this area right into here, and had a good, pretty big run up. We didn't trade the whole move up. I think I can't remember where I got out, but I've had a few trades on this. But notice this large bowl that's forming. If it breaks out of here, it's probably heading to that previous high. And then maybe it consolidates. Maybe you get that handle, couplet handle formation, which I wouldn't really want to hold it through that if it does that. But this is one that should make it back up to this previous high right here. And so, that could be something that's maybe just a shorter term trade where you just trade that momentum to that previous high. This is a stock that's done pretty well over the last several years, last few years. And it obviously got beat up through here, but it pulled back. It has a nice pullback. Looks like it's trending back up again. All right, and then I'll save the rest for Thursday's class. We'll go over some other ones in Thursday's class. All right, let's take a look at portfolio. Lily's pulled back a little bit. Our stop is down here, so we're not in danger of getting stopped out. We're getting close, but I would imagine this will find a little bit of support here soon. And if it's going to rally back up, it should find support here pretty soon. I don't think we'll get stopped out. And I think we moved that stop up, if I'm not mistaken. I think we had it down here and we moved it up. So I can double check that, but it would be a smaller loss if we get stopped out, or maybe even still be a profit. I have to see where that stop is and where we got in. LPX. Still looks good, even though it's pulled back a little bit here. Again, notice the impulsive move on the breakout, and this is more corrective. That's why I still am optimistic that this should find some support, start moving higher. We should get a higher low. And if it does that, if it breaks out, we can move our stop. I think our stop's down below here. We can move it up right below that, wherever that low is. I'm not saying that stays a low there, but it could end up being we could put that in pretty soon. LPI finally starting to move. This is one of the oil stocks. Now I got in this one when it was still a hold signal. We had our stop, I think, down below here. We could probably move our stop right below here now that we're breaking out. Let me make a note of that. LPI. And what would that be? That would be 59, say 59.85. I see that one starting to move. Now, this is what's always tough, is, the ACLS right here, we're in the extreme reversal risk, and we're getting a bearish candle right here. There's a high probability this thing's going to pull back a little bit more based off of that bearish candle. It doesn't. All this is very short term, though. Maybe it just opens lower and then takes off again or something. So, do you take profits on that with the idea you could always get back in, or do you just let it run? That's kind of the curse of reading short-term price action in trades that are designed to be a little bit longer-term trades, is that you start to if there's a high probability this thing's going to pull back and you get back some of those profits, why not just get out? So I don't know. I'll have to make a decision on that. What I'm going to do on that one. I wouldn't mind getting a little bit more of a cash position. Especially in some new areas, it might want to put some money in some newer areas. But I'll take a look at that. There's another one too. There's a couple of these that I'm kind of faced with that decision on. KRUS, this barely broke out, and it's just kind of pulling back a little bit. That still looks okay. VNQ is another one. It had a bearish candle yesterday. It's trying to hold up a little bit today, but this one looks like it's going to slide down a little bit. Maybe retest the breakout area down here. So this is another one I might just go ahead and take profits out. Again, the danger though is that this could be very short term, and then it takes off. I remember, I think it was Tesla. an earlier trade on Tesla that I had a bearish candle. I got out, and then it just exploded a short time later and really made a big move. In fact, I can show you where it's at. We pull that chart up. And so there's always that risk. Oh, here's the Tesla chart. It was back, I think it was back in here. Had a bearish reversal candle. It was in the extreme reversal risk, and then it shot up right there. It missed that move. So that's a little bit of the danger. Tesla, it had a nice move yesterday, but it's kind of a bearish candle today. I still think this should work its way up to. I don't really want to get out of this one until it can. I think it's going to break out, so I'd want to kind of hang on to that one. That's another thing too, is when you do break out, you're at all-time highs. And I don't know, maybe we can look at these other ones. Is there another reference point? Well, let me get through the list here, and then we'll take a look at those. But Ford had a nice move today, put us at the far right side of the extreme reversal risk. But this is one of those situations where, as well, where it's like, maybe we'll do that right here. Let's take a look at a 2-year chart. We might have to go back a lot further than that, because this has been trending up for a while. If we go back, I don't want to take up too much time doing this, but I can go back and look. What I'd be looking for is where, when it traded up in this area before, which might be back a few more years, is there any resistance at this spot? If there is, I might get out because it's probably going to pull back off of that. Now, a lot of these stocks are at all-time highs, and that makes it even more difficult to manage because you don't have the other reference points to know when the selling could begin. You don't want to give up a big run like you had, a big move. I personally just have a tendency, maybe it's more of my short-term trading that I like to do, is when you get a move like that over a short period of time, the probability is that it's more likely to pull back from that move or move sideways from that move than move even higher. There's a 2 out of 3 chance, at least in the near term, that it's not going higher from here or not much higher from here. And so I look at those probabilities. That's why I usually like to take profits on a day like that. But that's the short-term trader in me. That's what makes it difficult sometimes to manage longer-term trades. Is when I see something like that, I just know the probabilities. And anyway, NSC still looks good. This is a railroad company. UPS looks good, getting ready to break out. All right. Let's go to the portfolio here, and see on LLY, we moved our stop up to 260. We got in at 261, so we'd have just a very small loss if that came down and stopped us out. Same with LPX, we're right at our purchase price. Our stop's pretty much right there. So a lot of these we've made that stop adjustment. I was going to add CLR. How much cash do we have? We have 8,000. All right, so let's pull up CLR. I want to get my stop down, put my stop down below here. So the low of that day was $40.75. Let's put it at $40.70 as a stop. Let's add to portfolio, stock specific class, stop price at $40.70. 100 shares would be about over almost 5,000. We have 8,000, so let's say 175. We'd be over 170. 165. Yeah, let's do 165. We want that portfolio percentage at risk to be between 1 and 1.5. We're right there. I like it a little bit closer to 1, but I think that's good. We're good. Let's go ahead and purchase. All right. And I'll make a decision on those other ones. I'll talk, if I do, I'll talk about them on Thursday if I decide to get out of them. I just want to see how the market looks at the close. And what I'm talking about is ACLS. Again, you've got this bearish reversal candle. Now, in this one, we're not at the far right side of the extreme reversal risk, but we're in the extreme reversal risk. VNQ. Have that bearish candle. See, if it was reversed, so this is the bearish reversal candle. Sometimes it'll shake those off and go right back up again, but you probably need it to be up at this point above yesterday's high if it's shaking it off. And the fact that it's not, and I mean, this looks like it's trying to hang on, and it looks like it's about to slip. Now, sometimes it might come down, just retest the lows down here, and then start rallying back up. Yeah, that's what makes it tough. Is that you see those bearish candles, and then Ford isn't a bearish candle today, but it's had such a strong 2-day move. I think I'll wait on this one because sometimes you'll get a move like that, and then you'll see it gap up the next day, and then it'll give you a bearish reversal, so it'll gap up and then start dropping a little bit. The danger is sometimes you can have that big bullish day and come right back down. Like, see, this is what I'm afraid of. This is what happened to Tesla yesterday. So Tesla had that big gap up, big move up, and then look, it's almost completely, well, not completely reversed because it did gap up. It's still higher, but it almost completely reversed the candle from yesterday. So that's the risk there. I'll take a look at some of those longer term charts. So, and then I just don't want to. We don't have any time left here, and I don't know how far back I have to go, so it could take a little bit of time there to look. But if there's any other resistance or significant resistance in the past at these areas, then I might go ahead and take profits on those. All right, that's all I have. Make sure I talked about everything here. Out of the watch list, I think I was going to boot out a couple because we're going to be adding a couple from today. But I'm going to boot out Zscaler, ZS right here. And this big drop the last couple of days, gone back to a sell signal. Just want to boot that one out. And then this DAVA right here. Again, big drop today. I'll just boot those out. And in fact, let me do that right now. All right. That's it. Have a great week. We'll see you on Thursday for the stock specific class. Bye now.